Yeah, mass unemployment, home prices are rising. Millions of people are not making their mortgage payments. It's a very weird time. And, the thing that we have this time that's different is these big institutional buyers and just regular investors who are looking to get yield any way they can. And, you had individual investors before, but you didn't have that sort of institutional buyer, whether it's the Invitation Homes or American Homes for Rent or other private equity firms buying homes by the thousands, or these firms known as iBuyers. They sort of use computers to identify mispriced homes and try to flip them. So now there's sort of this interesting thing where there's sort of a floor on prices in a lot of markets. As soon as they hit a certain point, that bid comes in and buys whatever it can. So there is potentially a little downside protection this time that we probably didn't have before. But the price is going up in a pandemic. It's a little bewildering. Interest rates are so low. It's sort of, I think a lot of people are thinking, let's act on that now. The COVID thing is probably spurring people who thought about moving to the suburbs and out of the cities to do it now instead of wait.
You are listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth. Hello, I'm Deidre Woollard, an editor of Millionacres, and today I'm talking with Ryan Dezember, who recently came out with a book, Underwater, that talks about the last foreclosure crisis and his own personal journey as a homeowner. I really love this book because it used a particular location, the Gulf Coast of Alabama, as a microcosm to explore what happened during the last foreclosure crisis. In the book, Ryan weaves together a lot of different stories to tell the story of what happened then, and I feel like right now is a really good time to be discussing this because we are in this odd space of market exuberance. So, Ryan, thank you for agreeing to chat with me.
Thanks for having me.
So, this book is your story and the story of a particular market. So just wondering if you could share with us a little bit about how the book came together, both on a personal level for you and also a professional level, because I know you're a reporter at the Wall Street Journal.
Yeah, so I started my journalism career, my sort of full-time journalism career at a newspaper in Alabama, and the daily paper Automobile, then called the Mobile Register. And they assigned me to the beach. And, I was this guy from Cleveland, Ohio. I barely was aware that they had a beach, but I said yes because it was cold where I was and it was warm there and they had a beach. So I moved down there and I was sort of like, what am I going to write about in this place? And I got there and I saw the beach and it was like Miami was like sprawling up to Alabama. I'm like, what are these towers doing here? Why are they building so many? Who are these people buying these condominiums? And it didn't seem like there were enough people there to support that sort of development. And so I started digging into that, and what was going on was just fascinating. People were basically buying condominiums or the rights to own future condominiums that didn't exist yet. And, trading them like they were stocks and bonds, everybody buying, higher than the previous person had paid. Sometimes these things would sell 6 or 7 times before, they were done and it was ready to move into. And I thought that was fascinating. My mom and my grandparents had sold real estate in suburban Cleveland. And, it was like a tremendous feat to sell $1 million worth of homes for them. And here realtors were selling, $30 million of homes that didn't exist yet in like an hour on the phone. And it was just mind-boggling what was going on. And so I said, I'm going to stay here. I'm going to write about this. This is really a rich story going on here. And there was all this sort of attendant ecological debates about this development, and there was, the attendant corruption for developers paying off the mayor to get the zoning, all that sort of Wild West sort of stuff you get in an asset bubble. And, so I did what a lot of Americans do when they sort of settle into a job after college and they get comfortable, and I bought a house. I bought a modest house, one of the cheapest around that wasn't like a trailer or some dilapidated thing. And I always thought, I'm writing about this thing. You can see the trouble coming on the beach, and then, off the beach is that sort of exuberance towards real estate investing took hold. And I never sort of like realized that I I was involved just by buying a house, even if I bought a house for shelter, that I too was in this sort of game that was being played. And, of course, you can imagine what happened. The market crashed severely. I ended up moving on for my career from Mobile to join the Wall Street Journal, and I couldn't move because my house was worth, $60,000-$70,000 less than what I paid, like basically like half of what I had paid. So I became a reluctant landlord, and lo and behold, I'm at the Wall Street Journal, and the Wall Street financiers, the Blackstones of the world, and all, these sort of bold-faced name investors were buying up foreclosed homes to turn into rentals. And, I'm sitting here thinking, I have one house, 1,000 miles away, and it's a nightmare to deal with, and it's very expensive to manage a rental property so far away. You have to pay somebody to do it. How are these financiers going to think they can do it on a grand scale by tens of thousands? But they did it, and they did it very profitably. And those companies have just become a very interesting and really, I would argue a big force in today's housing market. They don't buy every house. They don't buy houses everywhere. But when they want a house and they want an area, they'll usually win. They'll get the house over a regular homeowner, home buyer. And so I thought it sort of would be nice to put the whole arc of that story, almost a whole market cycle, together, from the small town in Alabama where you see it, the bubble inflating and bursting, and then sort of this new powerful industry that emerged from it.
Well, I thought that was really interesting in the book, too. You explained basically what happened to your neighborhood and the changes that it went through. And I thought one of the things that was really sort of a little bit heartbreaking was what happened to your neighborhood, the overgrown lots, the homelessness, the sort of, the way that it changed. And do you feel like it's possible for neighborhoods to come back from that? And does it ever make sense if you're an individual investor and you see a house in a neighborhood like that? Does it make sense to invest in that in the hopes that it's going to come back?
Yeah. And, I don't, because I didn't live there, it's hard to say, but I do think that the neighborhood came back. Certainly property values came back. Mm-hmm. Being sort of the cheapest homes around that were like an established neighborhood, they were in high demand as soon as there was demand for houses. It took a long time there. The Wall Street guys didn't go to that area. There's not enough density. It doesn't have the sort of growth profile that they look for. It's not Phoenix. It's not Houston. It's not Denver. It's, a small town in the coast of Alabama. So prices sort of fell beyond what they did in some of those more active markets. And so it took a lot longer. It took me from the time I first tried to sell the house in 2007, where I figured out, whoa, there's a problem here. I'm not going to be able to sell this thing until 2017 when I sold it. It was 10 years. And I still sold it for a loss. But values had risen. The foreclosure inventory had rolled off. People had, in that neighborhood in particular, a lot of retirees came down and bought homes very cheaply, even if they weren't ready to live in them and retired. People in Michigan, Wisconsin, Ohio, that we call them snowbirds, that come in the summer or stay in the winter and are sort of counter-cyclical to the tourists. A lot of them end up retiring in that area. And so there were people that bought homes really cheap and fixed them up and have moved in. And the last couple times I was down there, the neighborhood did seem a lot better than when I left it and sort of what I knew about it when I was a landlord and I had renters in there. It's hard to say what's going on inside the houses, but they did look okay. As far as investors, this has been happening. It's been a huge boom since the crash. North of 10, better than one of every 10 homes sold in the U.S. since, I think it's like 2010, basically the last decade, has been bought by an investor, whether it's a big company on Wall Street or an individual like you or I, or, even somebody's self-directed retirement account. People buy rental homes with them. And one of the interesting things that we've sort of noticed at the Journal in the last few years is, while the Sunbelt markets are hot with the big companies, the individual investors really make a good margin and are really attracted to what we call like fixer-uppers, right? Cleveland, Ohio, Pittsburgh, Akron, Toledo, cities in Michigan and Wisconsin are some of the most profitable places to buy a house. It's like a fix and flip, but often you're not flipping it to sell it. Often you're renting it out as an income-producing asset. Everyone's looking for something to put their money to work with rates so low. So I would think that, those sort of neighborhoods, now you don't want to buy into a neighborhood in serious decline, but I do think that there's an appeal to investors in that the yield is there on those sort of houses, and they take work, and they're risky. You have to fix them up. You have to, like, convince somebody that, like, this house that was a disaster 5 months ago is a great place to live and to move in and pay a high rent. So I do think there's probably that those, as much as everybody thinks, like, oh, it's terrible to live in a neighborhood where, investors are buying the houses and fixing them up and raising the prices, sure, it can hurt your property value, or it can raise your property taxes and values and stuff. But, at the same time, that's how things turn around.
Yeah, I think one of the things that we see with investors is the BRRRR strategy, where you buy, rehab, then refinance and do it all again. So I think that's become much more popular among investors.
Like, there's not much place to get a yield, right? Where are you going to get a return? And if you can get a house for $100,000, put $20,000 fixing it up and then rent it for $1,300. That's sort of the landlord's magic number, is to get 1% of the purchase price of the investment in monthly rent. And that's hard to do if you buy a really nice house in a great subdivision and a great school district, but you can do it in sort of these sort of more off the beaten path places or homes that need a lot more work.
Well, and you sort of ended up being a little bit of an accidental landlord, because you had your house in Alabama and then you had to move to Houston. So and you had some misadventures there with tenants taking things. What advice would you give someone if they ended up in a similar situation?
Well, I've thought about that a lot, and I sort of studied it after the fact. Like, should I have just walked away and, like, taken a chance with, fighting with the bank over whatever wasn't covered in a foreclosure? If you walk away from a mortgage in most states, Alabama included, if you owe $100,000 and then they put the house, they auction it on the courthouse steps, and they only get $50,000, you owe them $50,000, and most likely they're going to try to get it from you and make your life difficult until you pay it. So I chose to sort of stick it out. Now, of course, I didn't know how long it would last, and if I did, I might have made a different decision. But I would say, like, I was very nervous about leaving a home alone and empty. And I sort of felt like as soon as somebody was in it, that sort of gave me comfort. And it was sort of a false comfort, because, like, there was turnover, there were problems with tenants. Some tenants would steal everything. Some tenants would stop paying and not respond to you for months until you threatened to evict them, and then they disappear in the night. There was all kinds of stuff like that. And I have to be honest, that was hard to deal with, the uncertainty of it. Even though I had, like, a reputable property manager, it cost a lot. It ate into my not even profits. It made it more expensive for me and deepened my losses. But a lot of people are doing it now, and it's by choice. I think having your mindset different, as if you go in it by choice, like, I live in New York, but I really think that, like, the national market's a great real estate market, so I'm going to buy some houses there, pay somebody to look after them. I think you go in with a different mindset where you're more comfortable thinking about it that way than if it's like your house that you live in and your home, and you walk away and you don't know what's going to happen, but other people are going to be living there. But it's still, I think that's like a sort of a different psychological thing, where if I was going to do it again, I would want to go into it, like, sort of not reluctantly and fully planned. And I would consider who, if it was at a distance, I would want to know who was going to be looking after it, rather than just hiring, whoever it was in town that does property management. I would want to have some sort of, like, trust, or almost like a business partner, a relative, a friend, somebody, like, really on board, unless I was, a big enough landlord to buy enough houses to really, like, pay somebody to do it full time for me. I think that's sort of the key to me, would be getting that comfort of like, if you can't be there, have somebody else that can. Some people, we hear about a lot of people investing in properties far from where they live. And, if you do it through a retirement account, often the tax rules mean you and anyone related to you can't have anything to do with the house. You can't send your, nephew over to cut the lawn. It wipes out the tax benefits. So in those cases, you sort of have to fly blind and do it. And the system's sort of set up for that to happen. And I guess in a way, it might not be that different than if you're investing in anything else. I mean, if you buy a big chunk of shares in some company, you don't know what the executives are going to do, really. You don't know what's going to happen to your money either. So I think having it be someplace that if it had been your home, and if you ever have like, you have that sort of emotional attachment to the place, that if it's purely an investment decision and you're looking for yield, you're thinking about yield. You're not worried about what's happening to the yard or the floors or whatever.
Yeah, it does let you be a little more dispassionate, I think. So I want to switch to talk a little bit about the speculation side of the book and kind of what happened in that condo market. So I thought one of the things that was really fascinating was the role that zoning and planning commissions play in real estate speculation. You mentioned earlier what happened to the mayor. I mean, do towns just get greedy, or what kind of forces do you think are at work when all of a sudden you see where there were single family homes, now there are these, giant condo towers?
Yeah, and the thing there, the debate was always like, there were people that lived there and they didn't want it to change, right? They moved there for a reason, and that was the place that they expected to live in. And so there were people who were like maybe sensitive to ecological issues. But then, in a town like that where, that was a tourism town, if you weren't making money serving tourists, you were probably making money building something that they could stay in or otherwise spend their money in, a condo or restaurants or shopping. So you have this other part of the town and the populace that really wanted the economic development, and like that was their livelihoods. And in that context, that those were the two forces, and of course the money won out. And it was like, it was basically came down to like 7 people in a small town. And if you could get 4 of them to agree with you to turn that lot that was zoned for beach houses into something that could hold a 30-story tower, then you could do it. So there was tremendous pressure on these like individuals who were, in these small towns, they're not career politicians. That the city council people were making like $10,000 or $15,000 a year for a part-time job. The mayor was getting like $20,000 a year for what was definitely a lot more than a full-time job. And the temptation there was like, okay, we can not only make the people happy that have voted for us and sort of be this hero that's bringing economic development to the town, but, get a piece of it for themselves as well. And that's what happened in that case with city officials. They just sort of couldn't put themselves in the mindset that they couldn't play the game because they were refereeing the game. And you got all kinds of wild stuff. And the mayor was taking trips and staying in developers' condos in New Orleans and, getting huge cash infusions, like big city politics in a town where there's like 5,000 voters and, PACs contributing, and really wild stuff for a small town where, a few years ago, the big issue was like, okay, do we resod the ball field? That's like the sort of town it was. Do we renovate the library? All of a sudden they're making decisions that, hundreds of millions of dollars are being made or lost depending on like one person's vote going one way or the other. And the just desire for people, once a few people started flipping condos and making money, and you heard, they would make hundreds of thousands or tens of thousands on a flip with basically no money down, no risk to their own, aside from a hit on their credit if it went poorly. Those stories get out, and all of a sudden everybody wants a piece of that. And then all of a sudden you have people that could never afford to close on a handful of $800,000 waterfront condos on the Gulf, yet they've got contracts to do so if they can't sell them to somebody else. And so you got a lot of people that just got swept up into the frenzy, and it was just this sort of ball rolling down a hill that couldn't really be stopped until it really just hit bottom and exploded.
Yeah, that's really true. I always find that one of the things that kind of mystifies me is when you see people flipping things that haven't even been built yet. And that always seems particularly crazy to me, but it absolutely happened because people got so wrapped up and they got so exuberant. They saw other people making money. They didn't want to miss out. And I think that's part of what happens. And one of the things I saw in your book, you did a really great job of talking about the auctions and what happened when everything kind of went the other way. And it seemed like it really took a long time for people to align their perception of what their condo was worth now versus what they had thought it was going to be worth.
Right. You get into it and everybody around you and all your neighbors, I made $100,000 flipping this, and it took a month, and you get into it and you're like, well, no one's coming for it now that I have it. That just that happened on a huge scale. And then of course the domino effect is, okay, I can't close on the unit developer, so I'm out. So he's going to sue you and go after you. The bank that said that they vouched for you and said they would finance, they walk away, they get entangled in the lawsuit. The developer doesn't sell the units he thought he did, so then he can't pay his bank loans and his contractors, and there's all those lawsuits. And then, in Alabama, there was a bank that was financing a lot of this stuff, and it all snowballed up to them. The local bank, they sold to another bigger bank, and it blew up inside of their bank. Some bank in Central Ohio, that really had no business being in like construction finance on the Gulf. Couldn't just like regular people couldn't resist the temptation of that sort of money. Like when I first got to Alabama, it was either early 2003 or early 2004. There was a realtor down there named Bob Shallow, and I read a little blurb in the paper that had just before I started. I was sort of researching and the sort of bold-faced names in town, and there's this little thing he sold. It was 30 some condo units that didn't exist yet. It was like something like 26 million worth of condos. And he basically just opened up his Rolodex, said it's open for sale, and sold all of them in an hour. Like, what do you do in an hour? Like, I couldn't do that in an hour. And it was just totally impressive to people. And, the thing with real estate is like you can kind of get an idea of what people are making because the fees are standard. You take like a 6-7% fee on that sort of transactions, and it starts adding up. And then you find, as soon as those people spoke for those condos, that realtor was able to then sell it for a little bit more to somebody else, and then somebody else. And it just really, people could do the math in their heads and realize these people who are doing real estate are making money like professional athletes and like actors. This is crazy high money. And, that inspired people to go into real estate, that inspired people to invest in real estate. Often with no money, of course. And it was just this like infectious disease that just spread around, and like no one, even very educated, otherwise very sort of savvy people, even got caught up in it. And then a lot of people who really shouldn't have been, and somebody along the way should have said, you know what we can't vouch for you. You make $40,000 a year. We're not going to give you a contract to buy pre-construction units that cost $800,000. But no one said, no one did. And of course, it all went sideways. And, the knock-on effect of that was once all those people walked away, the banks were hurting, construction stops, businesses come to a halt. And then the regular people in town, the people that lived in my neighborhood, suddenly didn't have the same paycheck they used to, or any paycheck. And then they get foreclosed. And that's when it like really cascaded. And that's when we think, okay, that's the financial crisis, the housing crash. But it was almost like a little like sort of aftershock of the initial thing where speculators just sort of walked away and left this sort of mess of unpaid for real estate.
That's a great place to take a quick break. We hope you're enjoying this and every episode of the Millionacres Podcast. If you have a moment, we'd love to hear from you. Please visit millionacrespodcast.fool.com and tell us what you think of the podcast so far, what kind of content and guests you'd like to hear, and what else we can do to help you grow smarter, happier, and richer through real estate. We're talking today with Ryan Dezember about his book Underwater that talks about the last foreclosure crisis and his personal journey as a homeowner. So you've just mentioned Bob Shallow, and I thought he was one of the most interesting characters in the book because he kind of got out. So it reminded me of the story that sort of famous investor story of Joe Kennedy left the stock market because the shoeshine boys were giving out stock tips. And I feel like Bob Shallow was a little like that in kind of seeing the crash before it was coming. So what can we learn, do you think, from people like Bob Shallow who are able to see like, okay, everybody's being a little too excited about this?
I mean, the main thing that stuck out to me is that if you were working with him and you listened to him, you would have done really well. And if you didn't, and you thought maybe, my buddy just became a real estate agent. He used to work at the outlet mall managing the shoe store, but now he's a real estate agent. I'll do this with him. I think that's where people got in trouble, right? Like Bob Shallow had clients who he was saying, we're going to stop. This money party is over. This is getting too hot, too toppy. The numbers don't work anymore. It's played out. We got to go to the sidelines. There'll be an opportunity later when the market crashes. people couldn't listen to. They couldn't stop. Those were just, you're like, okay, that's like the gambler who can't stop. But a lot of other people, I think, just got bad advice. So I would say, like, Bob Shallow, some people would say, oh, well, look what he did. Look what he did. He started this whole thing. He was sort of the guy that got the ball rolling and brought people with money to town to invest in these condos, which enabled the development and spurred more development. But he was the number one grossing realtor for RE/MAX worldwide for like 3 years in a row. And in the top, he may still be in the top 5. He's still very successful. So you're sort of like, well, there's people like that who sort of just knew and had been through cycles before and understood what to look for. And I think the thing you can learn for them is to like work with them or imitate people like that, but not, a lot of people try to imitate the result without imitating everything that came before in, all the research, the knowledge, basically the experience. He had started out in the savings and loan crash. So he knew what it was like to see a building get built and have no one move in after they'd signed contracts saying they would. So he saw the conditions and knew what was coming. And a lot of people, myself included, I had never seen something like that. I was a child during those times. So it wouldn't have occurred to me. All I knew was real estate goes up. So if you want some, you better get some now because it'll be more later. Which, even though that's sort of a conservative way of thinking about it, it's still like a speculator's mentality if things only go up. It's, just sort of another way of acting on it. But yeah, Bob is a real hoot, a fish out of water for sure down there, sort of a fast talking New Englander in a small fishing town resort area, and sort of an unlikely person to, in those sort of towns, it's usually somebody who grew up there, who's got a family name or whatever. And so it's sort of, he was a very interesting character because he'd sort of come there and conquered it, doing it his way, which I thought was very interesting, and made him such a good character. Besides the fact that he, like you said, you sort of think, okay, he's the guy leading the charge if he's going to blow up, and he sort of knew to step back. So I think that's the thing that we always forget to look in the past, and like we have very short memories. don't remember that these things can happen. And like I would say, like the thing you can learn is just to follow somebody, find somebody like that, and listen to them when they talk, dispense advice.
Well, I think that's one of the things that is happening right now that has me a little concerned is, we've seen like the real estate market this spring and this summer has gone crazy, post pandemic, and we're seeing prices go up. National Association of Realtors, existing home sales, they keep going up and up. Prices are, now up double digits year over year, which is just seems, it seems really, really speculative again.
Yeah, mass unemployment, home prices are rising. Millions of people are not making their mortgage payments. It's a very weird time. And, the thing that we have this time that's different is these big institutional buyers, mm-hmm. and just regular investors who are looking to get yield any way they can. And, you had individual investors before, but you didn't have that sort of institutional buyer, whether it's the Invitation Homes or American Homes for Rent or other private equity firms buying homes by the thousands, or these firms known as iBuyers. They sort of use computers to identify mispriced homes and try to flip them. So now there's sort of this interesting thing where there's sort of a floor on prices in a lot of markets. As soon as they hit a certain point, that bid comes in and buys whatever it can. So there is potentially a little downside protection this time that we probably didn't have before. But the price is going up in a pandemic. It's a little bewildering. Interest rates are so low. It's sort of, I think a lot of people are thinking, let's act on that now. The COVID thing is probably spurring people who thought about moving to the suburbs and out of the cities to do it now instead of wait. There's probably a bunch of people who realize like their apartments are great to sleep in during the weekends, but not a great place to have a home office or children running around trying to have homes being homeschooled. So I think there's probably some point in the not too distant future where the sort of qualified buyers start to run out for houses. And then more and more of the homes that are on the market will probably be bought by investors who who may just buy them at the current prices, may wait for prices to come down a bit. One of the really interesting things now is companies are raising hundreds of millions of dollars to build houses just to rent, which really says something about the profitability and their outlook toward sort of this permanent suburban rental class, that they would build a brand new home and build it expressly to rent out.
Yeah, we're seeing more and more of that. And I think that's partly because the home ownership is just out of reach for so many people at this point, and they still want to have the experience of living in a home. So that becomes part of it. Certainly you mentioned before Invitation Homes and, Blackstone investing in them, and then Blackstone sort of got out again. And so now I'm wondering too, if we're going to see another big round of capital kind of getting ready for what potentially could be a foreclosure crisis, not this year, but potentially like a year or two down the road.
Well, we're already seeing it so far, like since the pandemic began, or at least the economic lockdown in the US, so like mid-March. Since then, I don't know off the top of my head, it would be like something like somewhere between $7 and $10 billion have been raised by those sort of companies. Since we knew that like tens of millions of people have lost their jobs, investors have looked at that sector and said, let's go into single family rentals. Invitation and American Homes for Rent, the two biggest public companies with about 130,000 houses between them, have both done, hugely oversubscribed and successful stock offerings. Big private investors, Blackstone sold out of Invitation Homes, which it created a decade ago, and now has turned around and invested. Another arm of Blackstone has invested, I think, 200 some million in a rival of Blackstone that's, got expansion on the mind. The Koch Industries has invested. Brookfield, sort of the Canadian answer to Blackstone, big property investor, has bought a single family landlord, raised $300 million for them to expand. The capital, a lot of the sort of large private equity owned landlords have been, selling these rent back bonds that investors just love because there's some yield and there haven't been any defaults yet. And those bonds are like a mortgage backed security, except for when you pay your rent instead of when you pay your mortgage, it sort of flows up to investors. So there's been, just since everyone shut down and the world sort of went sideways, there's been this huge influx of capital into that sector. So you're right. It's hard to say whether there'll be a foreclosure crisis because, the government regulators sort of have their finger in the dike right now, holding everything back with a moratorium and the typical forbearance period that government insured mortgages have, or government backed mortgages. Eventually those protections will have to be let go, right? And something will happen. What's really interesting is the last time that we had a big foreclosure crisis, prices were plummeting and people couldn't sell homes. Now there's a historically low number of homes available for sale relative to US households. There's a lot of people coming of age, like a big demographic wave of people. You might have heard of them. They call them the millennials. Those people are just, that's the time to buy in their life. So you have these conditions set up between investors, regular old house hunters, and, the shortage of homes, but yet home prices are rising. So you could conceivably have people who are forced to sell because they can't make payments anymore because they've lost work, but they have so much equity in their homes because prices have gone up so much in recent years. It's like almost like you could get booted and then handed a check for like $100,000 or something. It's sort of inconceivable what's going on, but I guess it really just shows that there's sort of this whole crisis, this current crisis we're in, has sort of redefined sort of the class lines, I think, a lot. I think a lot of people who probably thought of themselves as middle class are reevaluating that now, depending on, what industries they were in and what their employment situation is. And I think there's going to be, sadly, a lot of people who are homeowners now who won't be in a year or two. And it could take years to play out. We always, in our meetings at the Journal, we're always reminding ourselves that we call it the 2008 foreclosure crisis, but home prices didn't hit rock bottom until like the end of 2011, early 2012. So it could be a long time before we see how it all play out, but certainly there's trouble looming.
Well, and that's a really good point that I always think about too, is that we don't know sometimes. And certainly, we always, someone always ends up holding the bag. But going back to iBuying, because I think that's a really good point that you made, that it's different now because there weren't iBuyers in 2008 through 2011, that it just wasn't a factor. And we saw recently Open Door, which was a startup, is now going to hit the public market. We're seeing Zillow, Redfin ramping up again after stopping during kind of the heart of the pandemic. So do you think that is going to be a larger part of the market, or is it still going to be just one option?
I think it's going to be a big part. I mean, it's hard to say. I mean, I always sort of looked at it sort of skeptically and thought, okay, like, is this like one of those things where once the VC money is spent, it'll sort of go away and it'll be sort of a niche piece of the market. But one of the things they have going for them is if they get stuck with a house, they really, the big iBuyers, they basically follow around the big rental companies and they look for the same sort of house. And a big reason for that is if they buy a house, say in a Phoenix suburb somewhere, subdivision, and they can't sell it to the open market where they think they can get a higher price, they can turn around to Invitation Homes, one of Open Door's early investors, by the way, or American Homes for Rent or Progress Residential, one of these really that we just talked about, these companies that have like billions of dollars on the books ready to buy houses. They sort of have a waiting buyer there. They're probably not going to get a great price, but at least they can get it off the books. And those companies are so desperate for, freshly painted homes that they can put people in. One of the really interesting things about the pandemic was, we were worried about, okay, how are people going to pay their rent? These big companies, they have had record occupancy, like record showings for any home that hits the market. They've raised rents. They never stopped raising rents on new leases. And now they've begun to raise rents again on renewals. And, if people are having problems paying, they wouldn't be at this record occupancy. And I think that's a reflection of the biggest companies targeted a certain type of resident. They wanted someone with children. And they went around and bought in good school districts and bought the sort of houses that you'd want if you had a child or two. The thinking is that those people are going to be less likely to move out over a rent increase. They're not going to want to move their kids to a different school or take them away from the neighborhood friends. They might just not want to move a house full of stuff, which somebody in an apartment might be no problem. So they targeted those people early on. And now the American Homes for Rent and Invitation Homes both, their typical tenant is a household earning $100,000 or more. They're sort of like late 30s, early 40s. They have a child or two. They almost always have a dog or a cat. These are people that stay in these homes, and by all accounts, they basically treat the places like they're their own, as if they're not going through like a college kid, like whatever, I'm leaving in a few months, trash the place. They're living there and they're in these homes, and that means they're probably going to want to stay there for a long time. So those folks you didn't see the economic damage to those people that you see maybe in apartments where you have maybe more service workers or, lower wage earners, younger people who sort of first in, first out sort of situations at companies. And they're having problems, but these home rental companies, the big ones, they're having the best, financial results of their existence, which is another sort of very bewildering thing amid the widespread job loss and all the economic woes that we have today.
Yeah, I think so too, because you've got this situation now where Zillow and OfferPad and some of the others are partnering with home builders. So you've got them sort of moving those like move up buyers into new homes, and then you've got those older homes being processed either to other buyers or to the rental market. So it's a weird sort of cycle that seems to be building that didn't really, all the pieces didn't connect before, and they kind of do now.
Yeah, it's very strange, and it's really interesting. U.S. single family homes, depending on how you count them, most days they're the biggest asset class in the world. But they never really, until 10 years ago, and really more recently than that with the iBuyers emergence, they never had big players. They were all owned, there might be a landlord in a town who owned 1,000, maybe, a few hundred. No one that owned 80,000 houses or 20,000. No one that was flipping, thousands of houses per market a year. And that just, it sort of speaks to this entire shift of real estate. Like, when you buy a home today, chances are you're going to basically, the process is going to be the same way your parents bought a house, and probably the same way your grandparents bought a house. It's a very old-fashioned transaction, signing a lot of papers, being in person, waiting for things to clear from person to person. And there's a lot of capital and sort of, brain power going toward changing that, to modernizing that, so that we can, buy houses the way we do stocks and bonds on these things, and that all sort of ties with who the buyers are. And those are the people those are the companies that'll be able to sort of, to sort of force that shift. And you see all these VC companies coming up with like their new angle on something. Some of it's like, oh, you guys just, reinvented reverse mortgages and like put a cute name on it and an app. And it's not, you can't really see how that could catch on, really, that it's a niche. But then other things like the iBuyer, like effectively a buyer of last resort. If you have an emergency or you have a job change and you don't have time to fix up your house and list it and have open houses, call Open-Door, they'll take care of it. You're not going to get as much as you would the other way, but a lot of people don't care. And those businesses, it'll be interesting to see how they work in a down market, because if people have equity in their homes, they're not going to quibble over the last 5,000 or 10,000. But if times get tough and prices start falling, that becomes a bigger issue. Or people who buy now at the top, and you don't see that appreciation, it's already expensive enough to sell a house with just the regular system. Are you going to take another like $5 or $10 off because they're going to paint your kitchen and put in some new carpet? That it'll be interesting to see how that goes. But all those companies are sort of, they all have a different angle, but the true sort of change is to really change that transaction from this sort of, buying a house now the same way you would in 1980. And making it like a 2020 sort of transaction. It'll be interesting to see how if they succeed. There's things like an appraisal, and valuation you can see a computer doing. There's other things like inspections and, just having a broker, a knowledgeable real estate person by your side as you are weighing whether to make what's for most people the biggest money decision they'll ever make. So it's hard to see some of that going away, but then other things you're like, well, yeah, sure, a computer can do that. If a computer can tell me how much GE stock is, why can't it tell me how much that house is worth?
Exactly. Well, thank you for your time. I want to wrap up with one question about the role of climate change, because I think it's something we're all thinking about right now. This year with wildfires, we've seen more hurricanes in the Gulf than ever before, and it played a role in your book as well, the impact of hurricanes. And so do you feel that is going to be a factor in terms of not necessarily foreclosures, but in terms of the value of homes going forward?
We've already seen in some places the coastal, like waterfront real estate has been sort of a harder sell. That's true. It's hard to say whether it's because the cost and the insurance and things like the risk. We also see that homes on golf courses don't sell like they used to. Yeah. And I don't know that there's like risk there. It's very interesting though, because, when you talk to like somebody in finance, they'll say, okay, what's the hedge on climate change? Well, property around the Great Lakes or property in Canada. These sort of like things where we see the charts that show, okay, by this year, this is where humans will be able to live, these very scary things. And yet the US, Americans are just still migrating to the Sun Belt, migrating to the coasts. Phoenix adds something like the equivalent of Kansas City every 10 years or so. And it's like they're out in the desert, no water. They don't have hurricanes or earthquakes, but they lack a lot of other things that humans usually need to survive. So it's sort of hard to square with the way we talk about this and the way that we think about this. And then when it comes to buying a house, we're like, oh yeah, let's go to the beach. But yeah, it came to mind when Sally hit Gulf Shores, Alabama, just, what was it, last week? That was, I think, 16 years to the day when Ivan hit and really just really destroyed the place and set what was essentially a blank palette for developers. It'll be interesting to see, do they have to, go out and spend $50 million to go out and scoop sand out of the water and rebuild the beach because they've knocked down all the dunes to build towers. Like, as these things happen, it'll be interesting to see if people go back to areas where they were. People really are stubborn and have a tendency to go back. Even, these towns that get burned down, and, people are moving back in. So it's a strange thing that we don't really always act on our beliefs in that regard. But yeah, so far we haven't seen any slowdown. If people were in mass thinking about that, places like Cleveland and Milwaukee and Detroit would be like Phoenix and Las Vegas and Miami, but for some reason they're not.
That is really, really good point. Well, thank you. This has been great. So people can find your book in bookstores, is that correct? And it's called Underwater, right?
Yeah, Underwater. Yep, wherever books are sold or lent. Libraries should have it too. So
excellent. And they can catch up with your writing at the Wall Street Journal, correct?
Yes, of course, always.
Great. Thank you very much.
Well, thank you.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. And if you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss, and Millionacres or The Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.